People were willing to pay a few more multiples for the same stock because they thought maybe the Fed was going to cut rates at the end of the year and the beginning of the year. Well, that didn't happen, has yet to happen, and may not happen for some time because inflation.
I ask you to take a look at a chart produced by a website called FactSet. Apparently, the chart shows market overvalue, but I can't make heads or tails of it. Please explain the chart. Can you describe what we have before us here in this chart?
Yeah, so you have a long-term chart basically following the price of the S&P 500, and this is like a 10-year chart, I believe, that's going back about 10 years, showing the S&P. So it's got the squiggly lines kind of going all the way back, lower left to upper right as the S&P has gained value. And then there's a black line that is following the forward earnings. Now, earlier in the show, I'd mentioned basically the forward earnings on how you can get one metric to value the stock market. So you take forward earnings and take it by its average multiple, and they track that on a line. And so when the blue line is above the black line, technically the market is overvalued. And when the blue line is under the black line, it's undervalued, right? Now, as you can see, though, when the market goes on a bull run, it'll stay overvalued for a long time. So there's not necessarily a panic. It's just a great judge. Are we, and the further it gets away, the higher that blue line gets away from the black line, that's when you want to get nervous, when the gap gets really wide, because it's going to correct to the mean over time.
I can see that from November on, that blue line, the price has more and more and more exceeded.
And so we did not have, so the rally we had started last November that ran through until the April. We had about a 5% drawdown back in April. But so if you go from back in the end of October through the end of March, we had a pretty good little bull run there. The market moved pretty fast, right? And so it got further and further away, and that just tells you it has to correct. It can't go on because it didn't do that based on earnings growth. It did it based on what we call multiple expansion. People were willing to pay a few more multiples for the same stock because they thought maybe the Fed was going to cut rates at the end of the year and the beginning of the year. Well, that didn't happen, has yet to happen, and may not happen for some time because inflation. So therefore, it probably means they have to come back to the mean. And as I said, if you were to give Goldman Sachs, who's I think the highest on Wall Street right now, that $245 multiple, the stock market's only worth about $4,800. Well, it's about 8 or 10% above that today. So at some point, it always reverts to the mean. That's math.